Let's take it across to the management of Asian Paints. Mr. Amit Syngle, MD and CEO of Asian Paints, is joining us to talk to us about their earnings. Amit, hi, good to be speaking with you. Well, you said that your Q4 numbers were impacted on account of price cuts. Tell me, what was the level of that price cut, the quantum, and going forward, do you anticipate further cuts?
So the total price decreases which we have taken is about 3.7%, and that is something which we felt has impacted the top line in terms of what we have seen for Q4, despite the strong volume growth of 10% in terms of what we have registered. Overall, as we see given the current geopolitical situation and other areas, currently Q1 seems to be, flat from a point of view of inflation, which might come in very, very strongly. So currently, I think we don't see any possibility of a price cut in the immediate future. But I think as the situation develops, we are, keenly watching the environment, and accordingly, we will kind of take action.
Okay, so not looking at price cut immediately, but help me understand the reason of this price cut. Is it a defensive strategy against competition? Is it perhaps to spur demand, or is it because of the raw material moves? What do you attribute the price cuts to?
No, I don't think so. There is anything of defensiveness to that extent. You must remember that year before we had taken almost about 25% price hikes overall, which we had kind of gone into that extent. So currently, given the fact that the environment has been deflationary in the last year, we have kind of adjusted so that, the value for money equation for the customer is something which is apt to that extent, and therefore it is more to kind of really adjust to the consumer needs to kind of really look at getting stronger demand back in terms of looking at it rather than any defensive action, because the gross margins today we speak of are pretty good, and overall the PBDIT margins are also looking quite good.
Okay, fair enough. But talk to me about the overall demand scenario. Now, given there is this hot summer, election, etc. in the first half, do you expect the first half to be a bit more sluggish?
See, overall, what we see is that, as we exited in March, also the last quarter, I think the demand levels were okay, a little bit affected because of the election fever to some extent in April, a little bit because of the heat wave, which is kind of going on. But we have seen certain sectors, like if you look at the area of institutional sales, B2B, I think that has been doing extremely well for us, and it is kind of really giving us good growths. The industrial growths have been very, very strong, both in auto and protective to that extent. Even from a point of view of the decorative demand, we have seen the rural sector definitely responding much better overall to that extent. And therefore, we feel that some demand gets affected in the first quarter because of the elections and so on and so forth. But there is also a little bit of a deferment of the demand, of Q4 in terms of what we are seeing, which is going to come into Q1 to that extent. So on the whole, I think as we kind of go ahead, the demand conditions look a little bit moderate, but they should be okay.
Okay, so that's the take on demand. You're at least expecting the volume growth in FY25 to be double digit. But what about EBITDA margins? They were clearly a disappointment in the quarter gone by. Is there anything that can suggest, Mr. Syngle, that the worst is over now with respect to margins?
Actually, there is no worst here to that extent. We have always stuck to our guidance of 18 to 20% in terms of the PBDIT margins. And today you will see we are very much above that to that extent. So while sequentially the PBDIT margins have come down, and vis-a-vis possibly, last year when we look at the entire financial year, the overall PBDIT margins are much, much higher in terms of what we see. So overall, I don't think so there is anything about a worst being over or whatever to that extent. I think we are comfortable in terms of the levels which we are kind of really going at. And as we see going ahead, we will have definitely, area where we will stick to our guidance in terms of the PBDIT margins.
Actually, let me reframe that and take a follow-up. Given the downtrading that you're talking about, slip in realization that will happen perhaps on account of that higher A&P spends, is it fair to assume that FY25 margins will be lower than FY24 margins then?
I think we will stick to the guidance between that 18 to 20% band in terms of what has been taken. And by and large, I think we should be able to kind of stick to the band, and even in terms of the PBDIT margins where we are today.
The single kitchen and bath category have been on the lower side. How do you plan to scale that segment of your business?
Yeah, so I think if you look at the overall home decor category, kitchen and bath are one part of it. We are also strongly into the area of lighting, UPVC doors and windows. We are into fabrics and lot many other categories to that extent. All the other categories have done extremely well. In fact, double-digit growths, which we have registered in the quarter and in the year to that extent in terms of all the other categories. Kitchen and bath has been slow last year overall, particularly bath. In terms of what we have seen, the demand in the market has been also fairly low in terms of what we have seen in the two categories. So to that extent, I think both the categories have not done well for us as we go ahead. But we think that as part of our home decor strategy, both are an integral part of it. And we have taken certain actions in terms of looking at synergizing both bath and kitchen into the Asian Paints umbrella far more strongly, so that we can apply the same muscle of servicing, branding, and promotion, so that we are able to kind of really rally these categories and make them big as they kind of go ahead for the current year.
Mr. Single, given the rise in competition, at least the posturing has started. Can you say emphatically at this point that fiscal 25 will see market share gain, which you had actually lost last few quarters? You think that will come back?
Yeah, see, today when we look at even the current year, which is the 23-24, overall, we feel that we've been able to kind of really maintain our shares to that extent, given the fact that we have gained from the unorganized sector as well to that extent overall as we kind of go ahead. We are pretty confident that as we go ahead in various sectors, given the fact that we have the right kind of strategies in place in terms of what we are putting in, I don't think so there is any erosion of market share is something which we are expecting as we kind of go ahead. In fact, our strategies around the brand, around supply chain, around other things in terms of what we are putting in innovation and so on and so forth are pretty strong. And as I said earlier, in terms of the newer categories which we are getting in, that itself will give you a boost in terms of really increasing your share as you go ahead in the market.
Mr. Single, before we let you go, a quick word on your gross margin picture. What kind of sustainable levels are you aiming at?
See, again, we are trading in terms of, almost like a 44% in terms of a gross margin to that extent. We maintain a band which is closer to about, I think, 42 to 44 kind of a zone. I think we should be kind of really be in that band as we kind of go forward, unless there are, real kind of disruptions in the overall raw material prices, which happens overall to that extent, in which case possibly we will realign our strategy in terms of looking at what would be the gross margins going for the market.
Okay, Mr. Single, on that note, we let you go. So no pressure on pricing, at least in Q1 so far. Demand environment is moderate and not too worried about competition and market share loss, even though the A&P spend will continue to be a bit elevated.
If you like this video, then like, share and subscribe to ET Now.